Hi there, option theorist. Neil here again. And it's a little later than I normally do this. I'm used to doing it in the morning before I go to work. I'm doing this video because I realized I have approximately 11 minutes to record a video on Leap Day. I won't get this opportunity for another 4 years, so I couldn't miss this opportunity. So, what came to my mind when I wanted to provide you guys some information, what I wanted to get out there in the world is, if you're watching this channel, you're probably someone who's newish to options trading and maybe even investing at all. Maybe you have been investing in the standard way that most people do, which is sort of in a forced way, and where you are participating in a 401k or a 403b because everybody else does, and you're just dumping money into it and whatnot. And maybe you're starting to question that. And undoubtedly, people will question you and say, oh my gosh, investing on your own, isn't that risky? You want to learn about options? Isn't that riskier? I mean, you'll hear it said that Warren Buffett has said that their derivatives, which options are derivatives, are weapons of mass destruction, and fire and brimstone could come because of these options that you're learning about. So I wanted to address that today, and I put together a little slide deck for you. So I'm going to pop over, instead of going into the Thinkorswim platform, which, by the way, if you're catching this video and you wanted to, I have a series, I'll link to it here, a playlist on getting started with Thinkorswim. And if you really want to have an interactive experience and you want to trade along with me, I do a trade basically every weekday. 4 of those days are cherry bombs. They come from tastytrade.com. Anyway, there's another playlist. I'll link to that here for our cherry bomb trades. And I think it would really be great to have you learn with us, right? Have some fun. So let me switch on over to our slide deck. Maybe I'll spice it up and I'll put myself in the corner down there. Nope, down there. Yeah. Okay. Everybody in YouTube videos, they always point like they know where they're, and that's not me yet. All right. So let's take a look at the slideshow here. You know what? I'm going to remove me. You don't need to see me. I will get my laser pointer out though. Whee! All right. So are options riskier than stocks for investing? So yes, it is February 29th, 2020. And I really want to have you think about that. Put an answer in your comment section below. If you agree, disagree. I'm sure because of the hour, I will be wishing I had done a better job with this video. But here we go. You've heard of the expression TLDR, right? Too long, didn't read. If this video is probably already too long, but I'm going to call it too long, didn't watch. Are you short on time? The answer to the question is no. Of course not, right? It's not the vehicle, meaning if the stock or the options, that determines risk. It's the investor. It's you. Are you a risky investor? Right? So that would be point number 1. And point number 2, for those of you short on time and who don't want to watch the rest, with stocks, you need to be right. Right? What do I mean by that? You need to be directionally right. Okay, so what does the inverse imply? Well, for those of you that are impatient and you got to run, you'll have to watch the rest of this video later, I guess. So bye. But if you're sticking around, we're going to dive into that now. So number 1, the first point was, it's not the vehicle, it is the investor that determines the risk, right? So with that said, smart investors, shrewd investors will enter positions with knowledge of these things. What is their profit and loss target for this trade, right? They have management systems. They know how to manage different kinds of trades, right? And they also have an exit strategy. They know what would need to happen for them to get out of the trade, either with a profit or a loss, okay? So that is what makes you a risky or a not risky investor. Do you take time to think about these things when placing a trade, right? Okay, so the next point was, stocks will force you to be right. And I said right directionally, right? So let's talk a little bit about buying shares of stock. So if you were to buy a share of Netflix, because in our last cherry bomb trade, which I'll link to, I'm pointing up again, you're not going to see it, I'll link to it again, our most recent trade, which I put on yesterday, and believe it or not, I closed it the same day. How about that, right? That kind of illustrates this point. So stay tuned in the future. I'm going to go over that. I plan on Monday to review the trades that we put on last week. So buying shares can be very expensive. I think Netflix, let me see if I can pull that up. Netflix here is trading for, or was closed at $369. So let's call that $370. You want to buy a share of Netflix? That's going to cost you $370. And then if you want to make money, right? Let me go back to that. If you want to make money, the only way to profit is with direction. So if you were long, you need Netflix to go up. And if you buy one share and Netflix goes up $1, you make $1. If Netflix goes down $1, you lose $1. And that's where some people might say, well, here's why options are riskier, because of leverage, because one option contract controls 100 shares, right? So that you're, I guess, a power of 100. So that if you were to really have shares put on you, you'd have 100 shares. So buying 100 shares of Netflix, let's call it $37,000, right? Many of you may not have that much in your 401k, your IRA or whatever, right? So buying stocks is also risky because you gotta put down, maybe that's your whole portfolio. Maybe that's 50% of your portfolio. That's a lot to put on one stock, right? And which, if you buy it and Netflix decides to just chill and flatline for a while and doesn't go anywhere or whipsaws up and down, stays in a range, you're really not making a lot of money, right? So what do options do that might be better than what you get when you buy shares of stocks and ETFs, right? Well, we'll take a look at that in just a second here. I guess in this slide, I wanted to review with you the risk profile of a long stock position, right? So here in this case, we're looking at the current value of Netflix, and the only way for you to make money is if Netflix itself, the underlying, begins to increase in value. I mean, that's a big old duh, right? Okay, I didn't move the price slices in here, but hey, you want to know what happens on any given day? Really, it's a 50-50 crapshoot, right? Although some will argue that the market has what's called positive drift and that there's a 53% chance that the market's going to be going up, right? Because, you look at the graphs and the market tends to move up over time. But I'll tell you what, if you've been tuning into the stock market recently, and let's say you were planning to retire March 1st, 2020, boy, that would stink, wouldn't it? Right? The market being down over 10% in 1 week. Okay, so the next slide is going to take a look at a short position. Okay, there's your underlying. And if Netflix begins to move up, you lose money. And if the directional move on the underlying, right, will cause you to win or lose, profit or loss. Okay, so to get back to answer my question, or the question, what can options do that might be better? Well, here, they give you more ways to be right. And when I say right, I mean profitable in this case. So number one, even buying options, which is not always, we try to avoid buying options. We'd rather be the person that sells them, right? But on occasions in low volatility environments, we'll buy some options, but never naked, if you would, never just single options. So anyway, here we go. Even buying options can be less risky than stocks because you can buy that same option for Netflix. You can buy a call for a few thousand, let's say 3,000 versus the 37,000. And if it doesn't move the direction you want it to, all right, we'll see a risk graph for that in a second. You're only out that smaller amount. Okay. Yes, if it has time value, once again, another reason why we don't want to buy options, right? We want to be number two, looking right here. Selling options gives you the most ways to be profitable, the most ways to be right. Okay. And that is because if we can be profitable if the underlying stays the same, thanks to time, because when you sell an option, time works in your favor. Okay. And if you are buying an option, time works against you. Right. So here we go. Letter B here, or the second way to be right or profitable with options is that if you, of course, if you're directionally correct, you will profit just as you would in any situation, okay? But here's the one I think that is most compelling. You can even be wrong. I know, let that soak in for a little. You can be wrong. And that's because you're paid a credit to take risk. You're the person taking the risk. As I would say this if I were teaching this in a course, you are the one selling the lottery ticket. You are the one selling insurance. Right? You can be directionally incorrect because you're paid to take this risk. And that gives you a buffer to be wrong. Whatever credit you receive for selling that option is your insurance, if you would. But let's take a look at a risk graph here. This is what happens if you were to buy an option in Netflix. Right here, this would cost you, well, let's call it $3,100, because remember, this would be multiplied by 100 with that leverage. I'm down here, right? And so here's the underlying at this point. And yes, this would be our max loss, would be that $3,100 if Netflix stayed the same or went lower. But see that if Netflix tanks, right, has a massive down day, you only risk that $3,100. If this were that long position, let's go back over here, right? Netflix can go, 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 go. And down here, right, $15,000 in loss. So one could say this is less risky, right? Now, here's the tough part when you're buying an option. Remember that cost? You need it to go up $3,100 or basically $31 before you begin making a profit, right? That's kind of rough. So you need to be right. And of course, at this case, it looks like that's a 33% chance. So you're buying the lottery ticket in this case, right? Not something we want to do, but you could argue that this is less risky than taking a stock position. Now here is what happens if you sell, and this case is selling a put, right? Instead of, and I don't worry about puts and calls, and I'm not teaching you about puts and calls. That's not my job. Though maybe someday I'll feel brave enough to do that. If you were to sell a 17 delta put in Netflix, right? And I cut it off down here, sorry. You'd get a credit of, let's call it $700. This is where the underlying is right now. And take a look at that. It's saying at expiration here, which is April 18th, you could collect a credit of $700-ish and have an 80% chance of breaking even, right? It can go anywhere in this range. Yes, you have limited your upside potential, but look at that probability of profit, okay? And you can be wrong this distance and still be profitable. Of course, you can be directionally right, okay? And if it stays the same, if it just kind of hovers here, you're still profitable. And we haven't even touched about the fact that you can be profitable with changes in volatility as well. So I hope this, let me go back to me. Hi, yeah, there I am, still here. I hope this helps you understand the risk that's involved with trading options. I think that's it for my slideshow. I hope you found this valuable. Leave me a thumbs up if you liked it. Leave me a thumbs down if you didn't like it. Tell me what your thoughts are. Tell me what people are telling you. What kind of grief are you getting from people? People tell you you're crazy? I know I heard it, right? So thank you for choosing to watch this video. I look forward to seeing you in future videos. Consider giving us a subscribe. Okay. Bye. Happy Leap Day.